In this week's episode of the Stock Scores Market Minutes, I'm going to show you how I measure trade performance. We'll then do the regular weekly market analysis, try and figure out where the markets are headed in the week ahead. Plus, I'll show you a couple of trades to consider, and then I'm going to show you the trade of the week, a stock that made a 20% return in just a single day, all coming up. All right, so welcome to the Stock Scores Market Minutes for February 4th, 2019. So this week I'm going to talk about how I measure trade performance. We want to always measure in a method that factors in risk. When the typical approach, where you look at percentage return or actually how much money you made on the trade, doesn't really factor in the risk that you took to make that profit. And so I use something called the reward for risk method, which I'll explain today. So the risk of the trade will take the closing price of the entry candle. So if you are entering on a daily interval, then the close of that day. And then we're also going to use the low of that candle, so the low of that day. Now, if we're day trading, then we're going to use a much shorter time frame, and I'll show you in an example in a moment how that works. So we take the entry candle to define the risk of the trade. It's the difference between the entry price and the low of the candle, assuming we're buying. If we're short selling, then it's going to be the close of the candle and the high price of that candle. Now we're going to exit at some multiple of risk for a losing trade and some multiple of reward for a winning trade. And I'll show you again in an example in a moment how this all works. And ultimately this will give us a reward for risk ratio, something that we want to track over a large number of trades to determine our average reward for risk per trade. Now profitability in trading comes from maximizing the probability of a profit and multiplying that by the average reward for risk. So again, let's look at a chart so it makes a little bit more sense. This is a stock that I traded on Friday, QTT. This was a day trade, so we're going to use the 2-minute interval to define our entry price and our risk reward ratio. So I bought this stock at 9:32 Eastern time when it made my action candle. That's the little pink dot that I talk about every week. And the closing price of that entry candle was 11.44. You can see it there printed, but it's a little bit tough to see. And the low price was 11.26. So that meant that the risk per share on this trade was 18 cents. Now I want to be clear, the fact that we're using the low of the candle doesn't mean that we put our stop loss at that price. In fact, it's way too aggressive to do that. But by using the closing price and the low price, we've got something that's always easy to track, in a spreadsheet or in a computer program, so that we can always define risk the same way. Now, I typically would use 3 times risk for my actual stop, sometimes even more. With this particular strategy, a -3 RR seems to work well. All right, so our entry is 11.44. Our low of that candle was 11.26, so we have risk per share of 18 cents. That means every time the stock goes up 18 cents, we get a multiple of risk, which we call our reward. So at this point, we have 1 times risk, which is our reward ratio, 2 times risk, and 3 times. And in fact, you can see it goes 4 and 5. All these lines that I've got drawn on the chart here define the reward for risk as the trade goes higher. So you want to measure your trading performance in risk-reward terms. Now in this particular case, the stock ended the day right up here. And if we go over to the left side, you can see that was a little better than 4 times risk. What that means is that if I risked $100 in terms of building my position size, I made $400. If I risked $1,000, I made $4,000. And then you track that in consideration of the probability of success to define the expected value of your trading strategy. I use this method. I've been using it for many, many years. It's just a great way to really measure performance with a true recognition of the risk that you take. And you want to try to get an average reward for risk ratio that is positive, but also in consideration of the probability of success over many, many trades. All right, well, let's get into this week's analysis. We'll revisit this concept when we look at the trade of the week. First up, we're going to take a look at the U.S. markets, as we always do, starting us off with the chart of the S&P 500 on the 30-day, 60-minute interval. And you can see that we've got consistent rising bottoms. We were in a little bit of a a pennant pattern through the week, and then we had the Fed, U.S. Federal Reserve, say that they are going to be patient with raising interest rates. That gave the market a spike on Wednesday, I think. Well, looks like Thursday there. Was it Thursday? It was Wednesday. I think my chart is actually not showing Friday's trading here. I'm not sure why that is, but January 31st, interesting. We'll have to figure out why that is. So that was Wednesday, and we went higher on Thursday, went a little higher on Friday as well. Essentially, we are in an upward trend on the SPY right now, and it's a bullish trend. It's getting a little extended to the upside, which you'll see when we look at the weekly chart, but the buyers are in control. And so until they are not in control, until we get a break of the upward trend line, you have to remain optimistic. Let's look at the longer term chart and see why maybe we should be a little bit careful. So yes, there's no sign of weakness here, but we are moving up into a pessimistic pattern, and we've essentially risen up to the downward trend line on the weekly. So you can see we ran away from it to the downside and then came back up and then ran away from it, really sunk low there in December. That was a good bottom fishing situation where we had our dead cat bounce candle. That occurs when you hit a new low, close above the open for the week. We did that second week of December, and then been moving up ever since. And now we have come up to that downward trend line where naturally you would expect some selling pressure. So we saw that a little bit late in the day on Friday, where there was a little bit of selling into the close on Friday. Nothing strong, but it does set up perhaps for a little bit of profit taking next week. Now again, there's no sign of weakness yet. The market is in that upward trend, but keep a close eye on it because we are due for some profit taking. Looking at the Russell 2000, this is the daily chart, and you can see on Friday there was this, what we call a doji, where you've got the market essentially closing where it opened. And that's hasn't happened in many days. You can see the market's been trending higher, and that is often a sign that a reversal is coming. Not a major sign, so don't get too caught up in it, but again, you know, there's some reason for some profit taking to come. Until I see weakness, I won't worry about it, but if I start to see breaks of those short-term upward trend lines, I'm going to get a little bit more aggressive on the sells. So moving along to the Canadian markets, starting us off with the TSX 60. This is the 30-day, 60-minute chart again. And much like the US market, we are in an upward trend in the short term. We've got consistent rising bottoms. There you can see that little bit of late day selling on Friday, which hasn't broken the upward trend line on the short-term chart, but it's coming back to it. Do we bounce off of it and continue higher? Maybe. Do we break it? Perhaps. If we break it, then we're going to get a little bit more cautious. Looking at the longer term chart, you can see that we have more upside until we get to long-term resistance. We've broken that downward trend line. We've broken through this little bit of resistance at the cup and handle pattern. So the weekly chart for the Canadian market actually looks like the market is more likely to go higher than lower. My common sense says when you have a market that comes straight up like that, you're probably going to get a pullback along the way. Haven't seen any sign of it yet, but something to watch for. TSX Venture, of course, the cannabis sector and the gold mining sector has been strong, and both of those have a heavy weighting in this market. And so we've had a nice bounce back here as well. We are not quite at the downward trend line, so we should have another up week before we run into some selling pressure. But this is a place where you can find some good trades in those microcap stocks. I would caution about chasing some of these things higher, especially those cannabis names. They've had a pretty good bounce, some of them anyway, have had a pretty good bounce off of support and are up quite significantly now. And I'd be more interested in when do you sell them as opposed to buying them now. On to the currency market. Let's take a look at the US dollar. A little bit of weakness lately. We've had, a very strong US dollar over the last year or so. And then in the last 4 or 5 weeks, you can see that there's been that weakness. We've broken the upward trend line. We've built a falling top. Now the next question is, are we going to break through that area of support and continue lower? It does seem like the world is maybe moving away from the US dollar as interest rates are not rising in the US as many expected they would. And so you're getting some weakness in the US dollar. Now that has benefits in many places. In commodity, we've seen commodity prices stabilize. Gold is up, oil is stabilizing. And so a weakened US dollar is good for commodities. It's good for emerging markets. A lot of their debt is priced in US dollars. So if the US dollar goes down, it's easier to repay that debt. So this is an important chart to watch for many different reasons. Canadian dollar, really heavily dependent upon what oil is doing because, of course, so much of the Canadian economy based on the oil market. And there you see we've had good upward move in the Canadian dollar over the last 5 weeks, but it's now getting up to that downward trend line where we would expect it to get stuck, at least short term. Perhaps it goes sideways for a week or two at the downward trend line. Then will it be able to break it? For now, you have to remain long-term bearish on the Canadian dollar, but optimistic that the downward trend will be broken. And if that happens, then we can switch our stance to at least neutral on the Canadian dollar. Interest rates, I always look at the TLT, which is the bond market ETF. This going up means interest rates going down. And so you can see that we've had a nice little run higher in the bond market over the last few months. That means interest rates have fallen. However, we're now at this resistance level, which is proving to be a bit of a barrier for the bond market to go higher. As expected, we're building something called a cup and handle pattern. If we can go sideways and then break through that cup and handle pattern, that'll be a bullish signal for the bond market, which means interest rates go even lower. However, we may also roll over and start to move back toward the lows. Right now, I think we're destined just to go sideways in the bond market, but we'll have to watch this chart week to week. For now, no real action here to discuss. On to commodities. As I said, with a weakening US dollar, we should see some strength in commodities, and we've seen that. There's the gold chart, which I've been short-term bullish on for a little while as it has been moving up. Still long-term, big picture, it's still stuck in this long-term sideways range that it's been in for a number of years. And until it can break through that overhead resistance at 128 on the GLD, I wouldn't get too excited about it long term, but short term, there's been some good opportunities in some of the gold mining names as they benefit from the optimism coming back to this market. It's getting to be a little late in the run. This downward trend was broken back there, and then the break from a rising bottom back at the start of December. Now we're getting a little late into the run, especially as we approach that long-term resistance. So I think if you see individual gold mining names that are showing good chart patterns, that's great. You can go after them. But I wouldn't necessarily chase these stocks higher because they are coming into a price ceiling. Oil chart. Well, we talked about oil a lot over the last little while because it got so beat up. And then it broke its downward trend, and then it built the rising bottom, and now it's starting to break out from the rising bottom. That is a bullish signal for the energy names. Now, I went through the charts of a lot of energy stocks. I don't see a lot of strength in the Canadian energy names. It's more so in the US stocks. We saw ExxonMobil, for example, do quite well. As oil moves up, we should see the Canadian names start to move up as well, but wait for them to break through resistance, wait for them to show good chart patterns. They're really not doing that yet. And so you don't want to get too optimistic about it. And of course, the fear chart, I've left this out a lot lately. In fact, I haven't had it in the market minutes in a long time, but I thought I would add it back, mostly because somebody asked me to. But I think it's an important chart to keep an eye on. It shows whether investors are worried about where things are going in terms of a correction. And of course, we had a correction, and when we did have that correction, the fear chart went quite high. You can see over on the left side of that chart, it was at a high point. It's come down a lot as the market has stabilized, but in the last 5-6 days, you can see that there's been a little bit of a pickup in fear. I think that's recognition by investors that we've come a long way in the last little while, and it's probably time for some profit taking in stocks, and maybe some people hedging against that by buying the VIX or buying the options on the S&P 500 futures. That sort of thing is how investors protect against downside. And so that's why we've seen a little bit of a surge here. I don't think it's a big concern yet, but what you want to watch for is if you see this VIX, the VXX ETF, start to spike up in here and move up, that shows us that there's some fear coming back to the market. All right, so my outlook then, neutral long-term on US stocks as they come into that resistance at the downward trend line, but bullish short-term. It's still in an upward trend, so you have to stick with it as long as it is in place. Canadian stocks, same ratings. Gold, neutral long term, we're still in that 3-4 year sideways trend, but short term is bullish. Oil, I have my rating bullish in the short term as we are showing a pretty good short term chart, but neutral long term as we still have a lot of pessimism to overcome. Stocks continue to move higher, but with less enthusiasm and less volatility, and so be prepared for some profit taking in the near term, but don't do anything until you see a break of the short-term trend. Now, gold is strong and there are trading opportunities in the sector, but don't chase them higher. Try to find fresh breakouts from low volatility. Oil is showing signs of turning. Look for opportunities there, but be patient. And fear is rising a little bit with stocks of late, but not a big concern yet. All right, so let's have a look at the stocks to watch. A couple stocks that I found using the StockScores Market Scan tool. I ran the abnormal breaks scan on the US market to find these. I did it on the Canadian market as well. Didn't see anything I liked on Canada. But this is a stock that I traded on Friday as a day trade, but it actually has a pretty good longer term chart as well. You can see the spike of volume here. You can see the spike in price, breaking the downward trend line from a rising bottom. A lot of the things I like to look for in what I call a bottom fishing chart pattern setup. Stock scores aren't above 60 yet, but that's okay for this strategy. It's an early entry type strategy where we get them just as the stock scores are starting to pick up again. The only negative about this, it was a pretty big move on Friday, and so I think that there's some potential for a pullback near term before it goes higher. So, you could be patient and wait for the pullback, or you could chase it a little bit here and maybe not get as good a reward for risk ratio. That's up to you, but keep an eye on how it opens on Monday to see whether it is going to pull back, because often when stocks have a big gain like it did on Friday, they often pull back a little bit before they try to go higher. Another one, similar chart, also a bottom fishing chart. You can see downward trend, broken, then build of rising bottoms, and then ultimately a break from the rising bottom. The only negative here is the volume isn't all that strong, but the price action was very good. Again, I'd like to see it pull back a little bit. It will improve our reward for risk potential, because of course we're going to run into resistance in around $26. So if you think about reward for risk potential, you've got maybe one, two, maybe 3 RR. Whereas if it pulls back halfway towards 18, now you've doubled your reward for risk potential. And that's one of the concepts I teach in the Stock School training. You can learn more about that at the Stock Scores website, but it's something that's very important to balance that reward for risk ratio. All right, trade of the week. This is always just an educational thing that I do each week. Show a trade that I did the previous week at some point. This is a stock I bought again on Friday, a day trade. Symbol is SE. And using our reward for risk concept, we entered this one at 14.31 right there, because there was a bullish action candle on the 2-minute. Our support price is 14.16, so that means the risk per share on this trade was 15 cents. That means if we use a $100 risk tolerance, then the size of the position is 660 shares, which is a position size of $9,445. Divide that by 3, because if you use margin, you can leverage a day trade like this 3 to 1. So you need about $3,150 in capital to take the trade. Now this one ultimately closed at an RR of 6.87, reward for risk ratio. So you can see there's the close, and that is 6.8 times the risk. And if you factor in slippage and commissions, I usually drop that by 0.2, 0.3. So we'll call it a 6.6. We'll call it a 6.6 RR trade with the slippage, which meant that it made a $660 profit. That was a 20.9% return on the capital that you had to put into the trade, and really one that you held all day. But if you can make 20% on a stock in a single day, I think everyone's happy with that. Very few mutual funds or long-term ETFs would ever do that in a single year. All right, well, that has been the Stock Scores Market Minutes for February 4th, 2019. Hope you found it informative. If so, please click on that like button, subscribe to the channel. If you want instant updates when I do a new video, click on the little alarm button as well. But most importantly, trade well.